Do you know what would have happened if you put $10,000 into the S&P 500 index at the beginning of 1950 and waited 60 years? Do you think you'd probably get $100,000 or maybe $300,000? No, it would have been worth $5 million. Let that settle in.
Hello and welcome, it's Kyle here, and in today's video I'm going to be discussing low-cost index fund investing and possibly why it is the best way to start investing if you don't have the knowledge, time or energy to analyze stocks and financial statements. And yes, this is the easiest way to invest if you have no idea about investing at all. And I'm telling you now, the facts say that 95% of you who do go ahead and stock pick won't be able to generate the returns that you would if you go ahead and do low-cost index fund investing. So if you don't have the knowledge, this is a great way to start investing, and also it doesn't require years and years of study. Best of all, you can start all this with as little as $10. In this video, we are going to cover what an index fund is, the pros of low-cost index fund investing, and how Warren Buffett would invest into index funds. I'm also going to be dropping some tax advice for those of you in the United States, the UK, Australia, Canada, or South Africa in order to help reduce the tax liability on the profits you make from your index fund investments. I'm also going to be dropping some other tips like other funds which, contrary to popular belief, have actually destroyed low-cost index fund investing. Yes, you heard me correctly. There are other funds out there which have generated returns in excess of 1,000 times greater than those you would have gotten if you just invested in an index. Also going to be sharing how you can start investing if you are under the age of 18 and much more. So at the end of this video, hopefully you guys will understand exactly what index fund investing is, and you can also understand why some of the greatest investment minds in the world, such as Warren Buffett and Jack Bogle, all recommend this technique. So it's a jam-packed video with a lot to cover. Let's dive right in. So what is a low-cost index fund? Let's break it down word by word, starting with index fund. So an index fund is a fund, either an exchange-traded fund or a mutual fund, which tracks a market index. I won't be diving too deeply into what an ETF, exchange-traded fund, or a mutual fund is in this video. It's not really the point, but just so you know, they are very similar. The main difference is that they have a slightly different legal structure. I will make a video about this in the future, but if you want to still go ahead and learn some more now, I will drop 3 useful links in the description box down below. So the important point there is a fund which tracks a market index. So what is a market index? A market index is simply a portfolio of multiple holdings. So many shares grouped into a single portfolio. Now, you get many types of market indexes. You get market indexes which cover entire stock exchanges. You can even get market indexes which look at specific industries within a stock exchange. You even get market indexes which look at companies based on their size, so large cap indexes or mid cap indexes. So starting with the broad indexes, an example would be something like the S&P 500 index or the Dow Jones Industrial Average Index. Now, both of these indexes include all companies from all industries within the single index. Then you get the industry specific indexes. An example would be something like the Vanguard Consumer Staples Index or the Vanguard Financials Index. Both of these indexes only include companies from those specific industries. Then you get indexes which look specifically at the size of the companies. So something like the Vanguard Large Cap Index or the Vanguard Small Cap. Now, when I'm saying large cap or small cap, what I'm referring to is the market capitalization, which simply means the value of the company. So how do you get the market cap? You want to take the number of shares available, or the technical word is the number of shares outstanding, and multiply that by the share price. That's going to give you the value, or otherwise known as the market capitalization of the company. And trust me, indexes don't even stop there. They're not specifically confined to just shares. You can even get indexes which look at real estate. So a real estate index would invest into real estate companies. You even get indexes which invest into bonds. Heck, it doesn't even stop there, guys. You get indexes which look at crypto, to commodity, to even things like hard currencies. If you even want more options, you can even invest into an international index fund, which invests in the largest companies throughout the world. So I think you get the point here. It's not that hard to see, but the options really are endless. Probably the 3 most common indexes you'll see quoted on news stations are the S&P 500, the Dow Jones Industrial Average, and the Nasdaq. These fall into the broad category of indexes, and they relate specifically to the United States. So now that you know what an index fund is, what is a low-cost index fund? A low-cost index fund is quite simply an index fund which has very low fees. Yes, fees. The thing that every investor should try to minimize in order to maximize his or her return. So all index funds have fees. These fees are levied by the managers of the funds in order to cover the general running costs of the fund. Now, you want to try and get your fees as low as possible. The lowest fees I'm aware of are mainly for the broad indexes, and it hovers around 0.03%. Now, the funds which offer these are the iShares Core S&P 500 and the Vanguard S&P 500 and a few more. You really want to pay attention to these because the lower the fee, the more money for you. I'll explain with a brief example. So you have Fund A and you have Fund B. Both funds return 10% for the year. Fund A, however, has fees of 0.03% and Fund B has fees of 0.5%. Which fund at the end of the year returns the most for you, the investor? Obviously, Fund A. So, in summary, a low-cost index fund is a fund which has multiple holdings grouped into a single portfolio and it has very low fees. So, now that you understand exactly what a low-cost index fund is, what are the pros of an index fund? So, the first one is convenience. You see, you can get your hands on an index fund rather easily. It really is as easy as putting your money into a bank. All you have to do is head over to your computer, sign up to your local investment platform of choice, assuming you are under the age of 18. Go through the whole sign up process and then quite simply select the index fund you want to invest in and it's done. All this can be completed in no time at all and it's a very easy way to put your money to work without having to do much work. This can be contrasted with something like rental properties which require a lot of work, whereas index fund investing literally just requires a few clicks on the computer. Now, when it comes to deciding which index fund you want to invest in, I recommend at this point that you do a little bit of research. Now, if you want to, you can skip to the end of the video where I discuss what Warren Buffett would recommend. For those of you wanting to do research, I recommend ETF.com. This is not sponsored, but it's just a website which I prefer to use when doing index research. You see, the first section deals with an overview and explanation of the fund. Then you have the expense ratio on the right, which is also very important now that you know how important fees are. You also want the average spread to be as low as possible because this indicates that the share has good liquidity. Liquidity meaning it is easy to buy and sell. So when it comes time that you want to sell the shares, you can within a few minutes land up selling your shares, liquidate your holdings and have that cash available to you. So this is the formula for the share spread. It's quite simply the price someone is willing to sell a share for less the price someone's wanting to buy a share for divided by the price someone is wanting to sell a share for multiplied by 100. You want this to obviously be as low as possible because it tells us that the share is easy to sell or buy and exchange hands and that it is not too volatile. So point in case the share we are looking at, when it has something like 0.01%, even up to 0.05%, it's a very liquid share. Now, the ESG factor looks at the resiliency of portfolios to long-term risks and opportunities arising from social, environmental, and governance factors. Now, we live in a day and age where the world is becoming increasingly concerned with the social impact companies are having on our planet. And for those of you out there who are social investors and have a social conscious, this would be something you want to pay attention to. This rating provides a snapshot of the companies within the portfolio and their social impact. Now, obviously for this one, the higher the better. The higher it is, it tells us that there are more companies in this portfolio which have a good social impact score. I'd also just like to touch on index weighting here, in this case market cap. Now, the two very most common types of weightings you get when it comes to index funds is market cap weighted and equal weighted. So equal weighting is probably the most simple one, so let's start there. So let's assume you invest into an index fund which is equal weighted and there are 10 companies in that fund. Quite simply, the amount that will be invested will be a 10th into each company. It's going to be an equal split amongst the 10 companies. Then let's compare that to market cap weightings. So for market cap weightings, the amount that's invested into each company within the fund will depend on the market cap of each company in the fund. So a brief example, let's assume you invest into a fund which has 3 companies, A, B, C. Company A has a market cap of $50 million, Company B has a market cap of $30 million, Company C has a market cap of $20 million. The amount which will be invested into A, B, and C will quite simply be 50% into A, 30% into B, and 20% into C. So if we continue scrolling down, we can see there that they have the share price chart, so have fun with that as you wish. And it also then has the numerical data for you, and we can also see there which countries the companies are located in. If we scroll down further, it then splits it by the different industries for us, and if we look even lower than that, it also shows what are the specific largest holdings within the index. So lots of data for you guys to go through there. So onto performance. Now for index fund investing, the performance one would receive from it would 99% of the time be better than the performance they would receive if they were to go ahead and pick individual stocks. This has been confirmed by multiple studies and is one of the pros of index fund investing, considering it takes literally no effort or time on your behalf. So let's look at the research so we can actually back the statement up. If we look back at 2021, between 15 to 20% of the active fund managers actually managed to beat the market index. Very briefly for you guys, an active fund is where you have a fund manager who decides which stocks he wants to include in the fund. So there's an element of stock picking involved. Then this contrasts to passive investing, which is similar to an index fund where there is no stock picking. You simply just pick a market index and that fund just tracks a market index. Let's just briefly look again at a little bit more research. If we look here at this Morningstar report, we can see here that over a 10-year period, only 25% of all active funds managed to beat their passive counterparts. And if we look at another report, we can see here that more than 67% of actively managed funds managed to underperform, so they did worse than the S&P 500 index over 3 years. Then it goes up to 72.8% over 5 years, and 83.2% over 10 years, and 86% over 20 years. I think you guys can see that the longer the time horizon, the harder it is quite simply to beat index fund investing. The scary thing here is that you have industry veterans who are struggling to beat the market. What chance does the average person have? Interesting fact here for those of you who care, Warren Buffett has even made a bet against hedge funds that they wouldn't be able to beat the S&P 500 over a certain period of time. And surprise, surprise, guess who on the bet? Warren Buffett. Now, I'm not here to completely trash hedge funds. Believe it or not, there are some hedge funds out there which have completely destroyed the market index. Take Jim Simons, a legendary hedge fund manager and mathematician whose fund, the Medallion Fund, returned 39.1% annually after fees over a 30-year period. This chances the 10% annual return which you would have got if you just invested into an index fund, which is assumed as the industry average. And I'm also going to include a brief snapshot here of other famous investors who have also managed to destroy index funds over a long period of time. What can we see from all of this? We can see that for the average person, their best bet is to go with an index fund, but I also just don't want to be entirely biased, and I want to provide you guys with two sides of the coin. And what we can also see essentially is that only the very, very skilled, only a handful of stock pickers, investors in the world are able to beat the market. So the next pro when it comes to index funds, and it's possibly one of my favorites, is that they are very easy to track. You see, when it comes to investing into an index fund, it's so easy to track. All you guys need to do is just remember the ticker symbol. So let's say you invest in the S&P 500, the ticker symbol is VOO. You can go ahead and add that to your stock app on your phone, your widget, or whatever you have, and essentially every single day you'll be able to tell whether or not your stock position is up or down. So the next one is diversification. Now, this is one of the beautiful things that happens when one invests into an index fund. What is diversification? Diversification is when you have a portfolio which is spread across multiple different companies. And why is this good? Well, it helps to lower the risk of your portfolio losing money. You see, by having your portfolio spread out across multiple companies, it means that if one company in your portfolio doesn't do so well, it's not going to have a major impact on the overall performance. Now, this contrasts to putting all your money into a single stock, which can have extremely wild share price movements, and they may be so wild that some of you may not even be able to bear. Now, trust me, you may think that you will not panic, but having all your money invested into a single stock and see it lose 70% of its value over a few months, trust me when I say this, you will struggle and you will panic and you'll want to sell. And that's 70% of your fortune just gone. So another advantage of low cost index funds is obviously the fact that they are low cost. You see, other funds out there, such as hedge funds, have very high costs. You see, you only begin to realize how cheap index funds are when you start to look at the price that some of these hedge funds charge for their services. Hedge funds can have fees anywhere from 1% up to 2%, and believe it or not, even higher. And when you compare this to something like 0.03%, you're looking at a multiple of at least 50 times or even higher. There is a reason for this though, and that's because market indexes or index funds, they quite simply are automated investments. They are set to track a market index. There's not much work required on the fund manager's behalf. This contrasts with hedge funds, where there is a hedge fund manager who spends a lot more time, research and effort in order to pick stocks to include in a hedge fund. So that's the trade-off over here. And when you just consider the fact that only a handful of hedge funds are literally able to beat the market in the long term, I think for most people they'll say, you know what, you can just keep your high fees and I'm going to stick with index funds. This is obviously a big win for index funds over other fund types. Now, we are going to go ahead and discuss some tax considerations which I think one should be aware of if they're just starting to invest. Now, fortunately, there are certain structures out there which governments have created that one can use in order to reduce their tax liability. Now, you know as well as me that we're always going to pay tax, but if there are certain options out there that one can use in order to decrease their tax liability, it's worth taking a look at them. So, what are these structures? Well, if you're in the United States, look into something called a Roth IRA. If you are based in the UK, you want to look at something called a stocks and shares ISA. If you are based either in Canada or South Africa, you want to look at using a TFSA. And if you're in Australia, you want to look at something called a super, otherwise known as a superannuation fund. Now, these are extremely powerful vehicles which help to reduce the tax on the profits that you make from your index funds, but unfortunately, these things are capped, so you're only able to invest a certain amount into these funds, after which you'll not be able to invest any more. So, worth having a look. I've gone ahead and included a few links down below for you guys if you want to do a little bit more research. Those are my viewers out there who are under the age of 18 and want to invest. Believe it or not, there are certain ways which you can. If you're in the US, you want to set up a custodian account. If you're in the UK, you want to set up a stocks and shares ISA. If you're in South Africa, you just want to invest through an investment platform which allows miners to invest, something like Easy Equities allows this. And if you're in Canada, you have to open either a formal or an informal trust account. And last but certainly not least, if you're in Australia, you can just open an online trading account, but you'll just need your parents to act as a trustee. But just so you know, for all of these methods I just mentioned, they will all require a parent or guardian. But there you go, if you're under the age of 18, it's a way to start investing. So, what did Warren Buffett invest in if he was getting into low-cost index fund investing, and how would he invest? Well, he'd follow two simple rules. His first rule would be invest into the S&P 500, and his second rule would be invest any cash you have whenever you can into the S&P 500. It really is that simple, and it's also a typical trait of Warren Buffett to be this simple. Why would Warren Buffett say this? Well, the S&P 500 quite simply consists of the 500 largest and most stable companies in the United States of America. And this is not to say that they are immune to downturns. Trust me, any investment has some type of risk, but unless the world were to just explode tomorrow, it's unlikely that these companies would still not be around. Now, I'm not a fan of looking at charts as evidence that something is a good investment. I always like looking at the future as opposed to the past, but if you go over to Google, you can quite clearly see that over the long term, the S&P 500 has performed very well. And you being the wise investor you are, understand that the reason why the chart looks that way, why the S&P 500 performs so well, is because the companies behind the S&P 500 continue to grow. And when it comes to timing, Buffett has been quite vocal saying that he's not a fan of picking a certain time to invest, so waiting for the market. He's just a fan of investing whenever you have the cash available, because he believes no one, quite simply, can predict the market. So that brings us to the end of this video. I hope you all enjoyed it. It was jam-packed with a lot of information, but hopefully you guys can take something from it and use it to make the right investment decisions in your life. I'll see you guys all in the next one.